Hello and welcome, I'm Cody Koch. This video is part of my question and answer series in which people ask me questions and I give them answers. Let's get to it. Cody, what are the different ways you can finance a business acquisition? Okay, there are actually hundreds of ways technically to finance a business acquisition. Everything from supplier financing to customer financing to on and on. There's a whole bunch of different things you can do. But in general, there are three primary ways to finance a business. The first way is equity. So equity simply means the cash that we as a buying team put up. So it's our own money, it's our own invested capital that we put into the business to acquire it. Equity is very common when people talk about business acquisitions. Now, the second way is simply debt. Now, there's a bunch of different forms of debt. You can have, of course, bank financing, you can have mezzanine financing, you can have asset-based lenders, and on and on. So debt is quite simply, and you probably already know what I'm talking about, it's where you go out and get loans and you pay it back through interest over time in some shape or form. The third way is a bit more unusual, and that is seller financing. Now, typically seller financing may be shown as debt on the books, but in many cases, seller financing may actually be in the form of equity or some hybrid between the two of them. And so seller financing means the seller of the business, the former owner, is willing to finance the buying team in the future for whatever reason. But in many cases, seller financing is absolutely required in order to get a business transaction done, simply because if they don't offer it, they'll actually never sell the business at all. So typically these three ways of financing are used in some sort of combination with each other. They vary over time with changes in the economy, changes in the marketplace, changing with interest rates. They do adjust over time kind of naturally to the market environment. So for example, let's say that there's a business that makes $1.5 million a year in EBITDA, and let's say the purchase price is $5 million, let's say. In that case, we may put down, let's say 20% of that purchase price in equity. So in a $5 million business, that would be $1 million in equity. And then furthermore, we're able to go get maybe 50% of the purchase price in the form of debt. And so $2.5 million may be in the form of debt. Maybe we borrowed against the assets in the business, accounts receivable, inventory, equipment, or maybe we went out and got an SBA guaranteed loan to raise that capital in order to help us acquire the business. Or perhaps we use some other creative financing, maybe mezzanine financing of some sort. Or in this case, the remaining 30% of the business, or $1.5 million, would be in the form of a seller financing note. So the seller would agree to some sort of note. Perhaps the seller's willing to agree to some sort of earnout. An earnout means the business's performance will decide how much we actually pay the seller in the long run. In most cases, the seller would agree to some sort of note that's meant to be paid out over time from the cash flow in the business. And these percentages vary. In some deals, it may be half equity, half seller financing, and no debt at all. Other deals may be very little equity, maybe like 10% or something, and 90% debt, and no seller financing whatsoever. And so it just varies depending on the environment, depending on the situation. And of course, there's many other creative things you can do. The seller can have some sort of equity kind of position in the business, some kind of derivative in some cases you may see it, a convertible debt into equity. There's all kinds of things that can be done in order to acquire a business, but these are the three primary ways, most simple ways that are the most common by far. So what decides how much equity, debt, and seller financing is being used is often affected by things like interest rates. It's affected by the overall economy. There are periods in time in which seller financing is very, very common. Everybody's doing it, and it may be 50% to as much as 90% of the purchase price of a business is seller financing. Other times in history, for example, more recently, seller financing is rather rare. Sellers may only be willing to finance anywhere from 10 to 30% of a purchase price of a business, and this purchase price is mostly financed through debt or equity. And so this environment changes over the time. So this balance, the capital structure, if you will, varies over time based upon what's going on in the overall marketplace. If this video was helpful, please hit the like button and subscribe. And I highly recommend one of these other videos. They've been specially curated just for you. Thank you for watching.